Good morning, good afternoon, and welcome to Develop Your Edge with Anthony Crudele. I'm your co-host, Tom Schneider, CMT with NinjaTrader. Before we bring on Anthony, I do want to remind everybody that futures and options trading contains substantial risk, is not for every trader. You could potentially lose all or even more than all of your initial investment. That's why we recommend you use risk capital. What is risk capital? It's money you can afford to lose. It doesn't keep you up at night, doesn't extend your retirement horizon. I also want to let you know that what we talk about here in the show contains neither trade recommendations nor financial advice. Also, past performance is not necessarily indicative of future results. So what we talk about here should be presented and taken solely for educational purposes. We do have a chat room. You can join the chat, ninjatrader.com/events. If you're watching on YouTube, feel free to hit the like and share, subscribe buttons. But if you want to join the chat and ask Anthony questions, you can come to ninjatrader.com/events, hit the play button, throw in the handle, and throw in your comments. With that all out of the way, it's my pleasure to welcome Anthony back to his show, Develop Your Edge. How you doing, Anthony?
Good, Tom. How's everybody doing today out there?
Oh, doing well today. I mean, it's great weather here out on the island. I'm out on the East Coast, up north, Long Island. But interesting day today. Just can't wait to hear what you have to say today.
Yeah, well, today we're going to be focusing on the first strategy that I ever built that actually turned me profitable. And these markets right now that we see here I'm going to be actually showing how that original strategy that I built, that day trading strategy, how I expanded it onto the daily charts, really helped me recognize the market environment. And so I actually I did a whole charting thing last night. I put it out there on Twitter where I talked about why I think markets are going to be choppy. I think we're seeing divergence between S&P and NASDAQ. Obviously, you got yields rallying. We've talked about that a lot here. 2 and 10 years keeps going up. I didn't see where they are in the last few minutes here, but it's just continuing to add pressure in the market. But when you also have divergence in the indices, and that's something that I'm going to talk about, is I think the current market environment, it makes it very difficult, because when the indices work together, you have the cleanest moves. When the indices don't look the same on the charts is when you have that bumpy road, right? You have a push and pull. You have a NASDAQ up, a Dow down, or a Dow up, S&P flat, NASDAQ down. And you have this divergence, which we're seeing this year with NASDAQ up on the year, S&P relatively flat, and the Dow down. That is the most difficult environment for traders. And I know that many traders out there will say, you know what, Anthony, but I'm only a day trader. I don't really care about that in the big picture. Why does that matter to me? Well, it matters because your technicals become less relevant during times when the indices don't work together. Period. The end. It doesn't matter what your intraday technicals are. I don't care if you're using order flow tools and say it's all I care about is this and that, because they could be buying NASDAQ, selling S&P, which then pulls it back. Things become less relevant on the very short term. But when the markets are working together, like they kind of were at the beginning part of the year, that's when we had the cleanest trades. And I would go out and I would venture off and say, I bet most people out there in the first week or two of the year probably traded pretty well. And I bet your strategies were working pretty well. And now you get into the end of Feb, beginning of March, where the market is not sure if a high or low is made. You've got divergence, yields going up. It's hard to identify the environment.
And Anthony, we talk about this divergence on our bookend shows, opening range and bars closing. And one of the theories that we've postulated is that we're in earnings season. Actually, we're towards the end of earnings season. February is generally when a lot of earnings comes out. And could that be a reason? Is this something where the divergence is almost seasonal that corresponds to earnings seasons? Because you do have some companies that are in the Dow but not in the S&P, or vice versa, I should say, in the S&P but not in the Dow. You've got some FANG stocks that might move NASDAQ more than it moves the S&P. And you have these companies that have earnings reports that could move the indices that they're a part of, but not the ones they're not a part of. Is that something that could be explaining some of the divergence?
I think it's part of it, but I also think that there's just themes to every year, right? And you look at last year, oil stocks at the beginning of the year were themes, right? I was watching the other day, oil was getting cracked, but then oil stocks were doing well. I mean, I think we're at this kind of mishmash. I don't know if those are even words, but I think I've heard people say them in conversations. But it's just, we're at this time where Of course, earnings matter, right? Of course, all of these things matter. Interest rates matter. All of these different things are happening. But when it comes down to it for us as day traders, most everybody here is a day trader, or at least swing trader. It comes down to identifying the environment and is it conducive to my strategy, right? And so these other factors that have their that are webbed into us in the center as a trader, we really don't know exactly how all of them are directly impacting them. And the one thing about earnings is that you have some of the biggest stocks are pretty much in all of the major indices, right? So, and they're always the heaviest weighted ones. So a lot of times the earnings don't matter as much because of that. They matter for the top 5 or 10 stocks, right? But when you have something where people are really searching for what the theme is, this is kind of what happens, right? I mean, I guarantee if I went and polled and asked everybody out there, maybe you guys put this in chat. What do you think the theme for this year is? Like, what is the theme? What is the one thing that you look at? Like, I go back to last year. A lot of last year, was a big part of it was like buying oil stocks, and oil was that really hot early on in the year. Like, it was just clear, right? What is clear right now? And I'd be curious if you guys put it in the YouTube chat, put it in the NinjaTrader chat. I'm curious what everyone thinks. And the reality is, and I bet this, Tom, you're probably going to get, if 100 people do it, you're probably going to get 95 different answers, because the theme is really unclear right now. Obviously, what's pinned against our markets right now is the fact that short to midterm interest rates, 2 and 10 year yields keep going up. And that is just not good for stocks. And then you start to see a breakdown a little bit in what you're seeing in the technicals. And it's like the yields could be upticking, but if technicals were still strong, the market would basically say, I think we can hold. But now that they're happening together, now it really matters, right? It always really matters, but it doesn't matter to us until it matters. And so that's the problem right now, is that I think that it's very difficult to really put your finger on what is the theme this year. And if somebody says, well, it's tech stocks because NASDAQ's up the most, you're going to tell me you want to buy the NASDAQ up 10% right now with the S&P unch the Dow down, and that you're going to turn that up 10% into 20%? Maybe. I mean, it's just one of those things where no one's really sure. And I think you have a lot of weak hands in the market.
Well, and I think you mentioned, the beginning of the year, we had an up month in January. There was a lot of the market's looking for a long bias, I think. And there was a lot of talk about, as January goes, so goes the year. And I think we had thought at the time that inflation was under control and that inflation was on the downtick, right? We've been proved wrong. So, that kind of just churns up the uncertainty back into the market. And you're right. I think this disparity could be a reflection of, okay, we might not be right about the way the market's going to go in this year. Where is the safest, or where is the most, I should say, can't say safest, right? But where should we be? Where should we be in terms of the indices? The NASDAQ's the place, great, but that might have reflected what was happening in January and not necessarily February.
Yeah, well, I mean, the thing is, and I wouldn't even say I think that the probability of a soft landing increased a lot, right? So it wasn't necessarily that it was consensus or necessarily that that's what everybody thought. But what happens is that everybody chases what they think the theme will be. Everybody chases what they think the narrative is about to change. So stocks are going to run higher. I mean, I talked about this earlier in the year. I was long Tesla and some of these other ones, and they just exploded. Well, first of all, you can manage risk from those positions and from those prices. And now they exploded. And it's like, okay, now do you want to buy Meta on that big gap up it had after, their earnings? The thing has just been slowly depleted, right? And you keep trying to buy the dip in it and it keeps going down. Amazon, Google, all the news that had happened with like the ChatGPT, all that stuff. The theme this year, I think, obviously is taking hold. I see a lot of people talking about it. Of course, it's going to be the Fed, right? Because what is the Fed going to do? How aggressive are they going to be with interest rates? And we'll find out. But that's not what we do here on this show, Tom. So I think that, but the point of that is that when you have a situation where you look at the markets and you say to yourself, wow, really, I think what is the current theme? I'm not really sure of what it is. You're always going to go back to the technicals to see, what is the market telling you? And I want to kind of get to the real premise of what we're going to talk about today. The first strategy I ever built that finally got me an opportunity to be profitable, right? And I remember when I finally got into, I think it was my 4th year, middle of my 3rd year of trading. Yeah, it took me a little while. I finally turned the corner with this strategy that I had been working on, and it got me to have a 6-figure year coming out of a period of losing where I couldn't really do much of anything. And it came down to the most simple thing. What is my biggest weakness right now? I think we all look at our strengths. I think when you're building your first strategy or you're trying to build a profitable strategy, I think you should go and you should write down your strengths and your weaknesses. For me, my strengths were I could be aggressive pretty much at any given moment. If I felt the market was giving me what I wanted, that was very easy for me. I was an overtrader by nature. I was very good at identifying, really good spots in the market, turns in the market. On most days, I was able to identify what type of day it was going to be. I had a lot of really good positive strengths. I had good intuition, all these things, but I still wasn't making money, right? What was my weaknesses? I overtraded. I thought I saw too many edges. And one of the biggest weaknesses that I had was one-way markets just totally crushed me. And it was really frustrating for me because I would come into a day where maybe I'd be long or short and the market would go my way and I would scalp or trade in that direction. And then all of a sudden I'd be like, okay, you know what? I'm going to reverse here. I'm going to start getting long or short. And I'd start fading the day, right? And I go from the guy who tries to make the 2-tick chump, right? I'm trying to make 2 ticks instead of lose 10 ticks. And then I just keep doing it and doing it and doing it and going against the grain on a day where I started off good, but now I'm trying to fade the trend and I'm just getting blasted. And I found that I had done that at least once or twice every month where I would give back at least 2 or 3 days of trading. And it wouldn't be just because I lost more, it would be because I traded more. So my commissions and costs would go up. And there's just all these things that people don't take into account when they say you can make money, 15 out of 20 trading days and you'll be profitable. Yeah, well, I did that for years and I still lost money. Why? Because the days I was wrong, I was trading too much and all the fees and expenses that went along with it. And I'm just like, this is nonsense, right? And so you start really questioning what's going on. So what I decided to do is to step back and say, what is the biggest weakness I have? And I'm going to fix it. And my biggest weakness was fading those one-way moves or not participating in those one-way moves and taking advantage of them. And I think everybody out there can relate to that. So I stepped back and said, what tools can I do to identify that? And I just went through the list. Boom, 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 right? How many in a row did I look to see what finally resonated with me? And it was Bollinger Bands. And I said, look, I actually think I see something here, right? We always think we see something at those charts where you're looking at it and go, I figured it out, man. I got it now. And it's so much fun, right? When you find out something at night or whatever, and then you go in the next day and you can't wait to implement it. You're so excited about it because you think you're ready to make money. And usually you will make money until it doesn't work again. And so I had already been through that phase a little bit. And so I said to myself, look, if you're really going to put something into play here, let's really figure out how this helps you with your weakness. So I think maybe we take a look at the charts. So let's take a look at the charts here. And one of the things, what I'm starting off with here is a daily Bollinger Bands. Okay, I'm going to double click on them just to give you the settings. And when you look at the Bollinger Bands, I don't believe the standard setting is 3 standard deviations. I believe it's 2. You have to check them. I've had these set for so long, I don't remember what even the standard settings are. And I don't use the middle Bollinger Band. I don't need it. And so what I looked for was 20 period, 3 standard deviation. I also wanted to update on each tick. And that's what I use, right? And then so those are the settings. And I have that saved in my template on NinjaTrader. So, okay. So now what did I notice when I was looking at the daily chart or a weekly chart is I noticed that, and I've talked about this a lot in this show, is that when the Bollinger Band's mouth is open, like a mouth, okay, right? They're open, like you see right here. If you go to current day right now, what's happening? Top is expanding higher, bottom is expanding lower. Anytime that happens, what you see most people typically look at is, well, maybe if it blips down to the Bollinger Band, I'll use that as support. That's why a lot of people will use 1 or 2 standard deviations. I like to use 3, and I'll explain why. I don't use these as support or resistance or like a blowout, right? A lot of people do use that for that. I look at it as the market is expanding and we are in a one-dimensional move, right? Let's go back. What was my weakness? My weakness was I faded one-dimensional moves. And you can see just by looking at the Bollinger Band, when the Bollinger Band is opening like a mouth, it stops contracting or going sideways, and it expands outside of the previous peak, which is right here. And it starts to get to the bottom one in this particular instance, it starts opening up and it's hugging it. We are expanding the volatility. We are coming out of this grind up. So if you remember here, and I don't have to remember, you could see it. We're grinding up. The Bollinger Bands are always contracting as we're going in on the bottom. Everyone can see this, right? But on the top, we weren't contracting. We were expanding to the upside. And eventually we took out these previous peaks, and then the top started to come back in, and the market started to have this Bollinger Band start to point back in. So at this point right in here, okay, the market is telling me that this rally could be out of gas. We are now either in mean reversion to sideways or potentially going to wait and see if the mouth opens and the market's going to start grinding lower. So that's phase one. And maybe we bring you in, Tom, to talk a little bit about that.
Right. And, the Bollinger Bands are volatility, a measure of volatility. That's what they're measuring. And so another way that I look at those bands is when the mouth is opening, volatility is increasing, which usually indicates a trend is in play or about to be in play, right? That when they're constricted, when they're closing, that's that sideways movement you saw right before this downward trend, before the Bollinger Bands open. And I think it's a great way to look at it. The bands acting as support or resistance really come into play when you're in a closed or a small lower volatility environment. But when they're opening, I don't really, again, same thing. I don't use them as support or resistance. I look at them as directional.
Exactly. And you look at a lot of guys like even John Carter, who I've been friends with, and I talk with him on my podcast. He uses Bollinger Bands a lot, and he uses them a little differently. He likes them to get really tight. And then when they start to expand, that's the options play. He looks in that direction. Right. And so that's very similar to what we're looking at here. So, for this, you start to see them expand to the downside. Mouth is opening, market's going lower. We're now one-dimensional down. So when you see this on the daily, it sets the tone for what is the backdrop to the current market. Right. I'm actually going to go, first, let me go down in time frame. Well, no, you know what? Let me do this first. I'm going to go to the micro NASDAQ. And the reason why is because we started off today's show discussing, I got some old tools back on here, but they don't matter. Whoops. Let's go back and put in the Bollinger Bands. And why I want to go to the micro NASDAQ is because I want to go there because I want to show how I'm seeing divergence right now. And so let's add that. And actually good that you guys can see this. And we go to template and I'm going to load, and we got Delhi's Bollinger Bands, and we click apply and they're right back like nothing happened. And so we click OK. So let me just delete some of these lines because they don't matter, just so we're not overly done here. Now, what we're going to look at here in the NASDAQ, what's interesting is when I said we see divergence, look what happens here. So the NASDAQ is almost more in a consolidation type mode because the top Bollinger Band just starting to peak higher, bottom just starting to peak lower. We're not hugging that bottom Bollinger Band. And the top Bollinger Band in the NASDAQ did not take out that previous peak. Everybody with me on this, right? So you have a different look in the NASDAQ. The NASDAQ is going to be, at least in my opinion, much firmer to the downside, firmer meaning that it's going to most likely hold support than the S&P right now, because this look is indicating to me that with using the Bollinger Bands. Now you can use other tools and stuff like that to help you identify that. But this current look tells me if I'm buying a dip, I'm buying it in the NASDAQ because the S&P is a much more bearish look. So I did want to show that first. So let's go back to the ES. And what we'll do is, it's on the CFDs. There's that on there. So let's go back to futures. And let's go back to the E-mini S&P. And now let's take it down to a 3-minute. And here we go. I'm going to take this and get rid of my candlesticks. I like OHLC. Let me click OK. Now, how did I develop the strategy? What did I look at? So if we know on the daily that the market is in sideways mode, if the market is in bull mode, if we know the market is in bear mode, forget about bull or bear market. I don't want to hear about that, because to me, that if we're in a bull or bear market, I don't think anybody really knows if we are in one right now. We won't find out till much later, right? And so at the end of the day, trying to know that exact theme is just not what I do. But I try to find out, what environment are we in right now? What environment are we in today? And what that tells me by using that daily Bollinger Band was, okay, I would get in trouble fading moves, right? Go back to the weaknesses. Let's start from the beginning. If I'm going to fade a move today in the S&P and I try to buy a bottom because maybe the NASDAQ is holding support, and I think, oh, maybe I want to step in and get long. These are the days I would get just punished, because you're buying the S&P, the weaker market, when the NASDAQ may be rallying, but the S&P just keeps ticking against you. Check, 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 right? Just beating you up. It's a little Rounders reference there. When that keeps happening, you're just like, why? It's like death by 1,000 cuts, right? I'm not saying that that's what's happening today, as you can see we're uptaking, but you guys all can relate to what type of day that is. And what ultimately happens is that I keep trying to do that because of something else that's going on, or I keep hitting support because we're in a downward trending market. So what I started to look for was very simply this: going to my 3-minute. You guys know I use this a lot in this show. It's my favorite chart. I would look for, once the market started to open, I would wait to see what the market would do with the Bollinger Bands. And anytime we would be going up, because if we're like right now, we're saying that the S&P is in bearish mode, I would not, first of all, I would be looking for the first short that I could get, versus on the downside, if we were grinding lower, I wouldn't be looking for a long. So how do I use the Bollinger Bands for that? And what I would look for is this particular instance. When the market's going up in the Bollinger Band, right, and it starts to come back down, it closes just like the daily, right around in here, I would look for this first mean reversion trade. And I would look to start to be short as long as this 3-minute Bollinger Band. Now, I'm adding other things, support and resistance levels and stuff like that. I'm looking for pure sentiment here. As long as this 3 minutes started to stay closed, I would be looking for short signals. Now, what's my reasoning? My reasoning is because the market came up in this particular instance, and the Bollinger Bands went up with it. But then once they closed, we get boxed in. So now I look at the market and say, now maybe we could go back to that primary daily trend of going down. So I don't try to short it, because I don't know if it's going to be a trend up day until I start to see the Bollinger Band start to close like we are in here. And so to me, if I had other reasons, I would look at this and say, let me potentially start to look for shorts, because we're now potentially boxed in. So does that make sense? I think we step back for a second again.
Yeah, no, that makes sense. You're applying your thoughts from the daily into the intraday, and trying to align those two directions as best you can.
Exactly. And so when you have these Bollinger Bands that, like now the 3-minute, I'll look at it and I'll say, okay, well, do I want to be short here? Right. And I'll anchor a VWAP, which you've seen me do, to the 930 time frame, or I'll do something else. I'm not going to add all these different things in there today right now, because I want to show just basically for this. And then once this starts to happen, I say, all right, now I can essentially stay short until the top Bollinger Band here were to get above this previous peak. Because it's basically, I'm looking at the market saying, if I think that we're going to stay in this band, I can keep selling into rallies, right? But if this top Bollinger Band starts taking out this peak, and maybe we're holding above a VWAP or something else, I might start saying, you know what? I'm out now. But it's not getting me to just keep staying with a one-dimensional move, right? Because I'm waiting for the move to stop with the Bollinger Bands. And then I'm going to get confirmation if the Bollinger Band is going to continue to expand, then why am I going to continue to look for shorts? I wait for the Bollinger Bands to come back in and that mouth to close again. And then I would look for that potential short, because we're in a down look on the chart. Now, let me show you something in the NASDAQ, right? So let's go to the MNQ. And we have a little bit of a different philosophy here, right? And so with the NASDAQ, So just based upon everything that I talked about, we said the NASDAQ is going to have a more bullish, let me move, sorry, I moved that, is going to have a more bullish look than the S&P. So therefore, if I get this up in this move today, I'm not selling NASDAQ.
That makes sense. That makes sense. And, one thing that I've noticed with the E-mini and here, you notice the top band is increasing. It's turning up, but not so much on the lower band turning down, right? So the mouth, just because we're moving up on the top band, doesn't mean we're going to move down on the bottom band. And so that could be, the mouth seemingly opening now. You want to take out those previous highs, I think, to continue that uptrend. But you're right, you're not looking necessarily for a short because of the daily bias.
Yeah, because the biggest mistake I would make is if you go back and look at the NASDAQ on the chart, I told you on the daily, I said it looks like it's sideways to potentially up. So why would I want to sell the strong market? I want to sell the weak market.
Yeah.
So I'm going to sell the S&P on the rally because it's a greater probability that the follow through to the downside is greater. There's going to be a greater response to a resistance or an indication of resistance in the S&P than the NASDAQ. The NASDAQ is already showing that you just don't want to sell the rallies. It's a stronger market to the upside. So when you see divergence, most people, a lot of times, will try to buy the weak and sell the strong. Oh, the NASDAQ's up the most today, or the NASDAQ's grinding. Maybe the NASDAQ's at resistance. I don't touch selling the strong. I sell the weak, and I buy the strong. So if the NASDAQ would have grinded down today, and then we would have closed the Bollinger Band in, I would have stepped in and looked to be long the NASDAQ. Why? Because number one, you got shorts probably trying to press the NASDAQ thinking that they're already stronger. Let's try and push them lower. You get the squeeze there, right? And you have more people that are waiting to buy the dip in the stronger market than the weaker market because they continue to lose in the weaker market. So for me, the one of the simple things I did was identifying which market on which days I'm better off trading. So right now, I am much better off selling rallies in the Dow and the S&P than I am in the NASDAQ. I'm going to buy the dips in the NASDAQ when the Bollinger Bands close in the shorter term. Of course, you overlay this. This is me coming in and identifying what side I want to be on. And in the S&P and Dow, I'm going to sell rallies until proven otherwise on the daily charts. And it just comes down from a simple philosophy because on a day like today, it's so easy to say, you know what? I think the market's weak still. Let me sell a rally in the NASDAQ. And you just could potentially get blasted. It could be a trend day up. Versus the S&P, I think you're less likely to get run over selling the rally because overall it is weaker. So sometimes it's just the simple things that I did that tweaked my strategy that took me from just coming in and buying support, selling resistance, or the other things that I used. I overlaid a daily chart into a 3-minute chart, and it helped me identify which side to more likely be on, which side I could also be more aggressive on, which in this case is more aggressive short S&P and Dow and more aggressive long NASDAQ. And it just helped me be a better trader because sometimes building your first strategy isn't always just about finding that perfect edge. It's about keeping yourselves out of a lot of bad trades and putting yourself in a better position for the good ones.
Yeah, really, really interesting. And I think, it's kind of like the probability stacking we talk about to keep you in the right side of the market. Exactly. Anthony, thanks for that. I know we're running up against time. I do want to address real quick. We had a great question this week. By the way, if you want to submit your questions on Twitter, you can use the hashtag AskDYE for Develop Your Edge, hashtag AskDYE, and just make sure you include at NinjaTrader in the tweet as well. Be following NinjaTrader. If you're in the continental 58 states, United States, we can send you appreciation token of our appreciation for sending in a question. This week's question, Ryan Lerman at OwlsFan954 asks, what do you think is the most important skill for a futures trader to have? So, that's a loaded question, and boy, that's it's a very provocative question, I think.
Well, I'll tell you this, because there's a lot of ways I can answer this. I'm going to answer it actually in 2 ways. One is I think you need to be somebody who can slow things down in the moment because futures markets move extremely fast. And I think a skill being able to lower your blood pressure in the heat of the moments to make better decisions, I think is one of the most important skills you can have as a trader. I've learned for myself personally that when I'm able to slow things down during the busiest times is when I'm able to actually see the clearest and to be able to make the best decision. So I think being able to slow things down in busy moments is key. But another thing that's extremely important, I remember my mentor told me this, one of them. I remember coming off of a day where I'd be like, you know what, I just got beat up today. You know what, I'm done for today. I'm going to go work out. I'm going to be I'll be ready to go later. And one of the things he said to me, he's like, Anthony, he goes, you are always so optimistic. You heal so quickly. And one of the things that I felt was a really good strength of mine was the ability to heal. I just put it behind me. I think as a day trader, whether you're trading options, futures, or stocks, you have to have the ability to put stuff behind you. You cannot be someone who dwells on the past, because that past will continue to surface and subconsciously it will hold you back from progress. So the ability to heal.
Love it. Thanks for that, Anthony. And I know you have a little bit more business to take care of right here.
Yeah, I want to mention the micro gold futures. If you go on cmegroup.com and go to micro gold futures, I get this question all the time. They're like, Anthony, I wish CME would put more micros out. I wish they would do more things like that for some of these other products. There are micros in so many other products, micro silver, micro gold, micro oil. And gold market has been very busy lately. And I know that I've talked about this lately. I think that the micro gold is a great product, not only just to day trade the micro gold, but if you want to invest in gold, like in some of your longer term stuff, this is a financially settled product, the micro gold futures. And so you could actually go in and you could, rotate in and out of your gold positions if you just want to trade the price of gold versus I think being in like a GLD or something like that. So I think that the micro gold offers such a great prospects for those that want really small, more precise ways to invest or trade in gold. But remember, gold expires. Pretty sure it's monthly with gold. So make sure you know what your expirations are when you're trading gold.
Right. Awesome. Thanks so much, Anthony. And where can people find you?
At Anthony Crudele on Twitter. I'm back on Twitter after a week off when those hackers came in and took my account, but I'm still seeing a bunch of them pop up and saying I'm the Porsche. I don't know what it is, like SEO something, and I just laugh. And that is not me, everybody. So if you see someone pinging you that is not me. I am at Anthony Crudele with no NFTs in my bio, and I will never DM you.
Awesome. Thanks for that. And yeah, glad to hear everything is getting sort of back to normal with that. Always a good quick half hour with you, Anthony. Look forward to next week. And thanks to you viewers for participating and watching on YouTube and ninjatrader.com/events. And we'll do this again next week. In the meantime, have a great trading week.
See everybody. Thanks for once again joining us for questions.